Most traders are looking for a magic indicator. They want a signal that tells them exactly when to buy so they never have to feel the weight of a drawdown. But the math doesn't care about your feelings. This account is currently sitting at an over 9,000% cumulative return, and it wasn't built on hopes or gut feelings. It was built on a clinical mechanical process that removes the human from all positions. Today, I'm going to show you how I moved from major drawdowns, where every real trade I made was usually a loser because I was scared money, to an annualized return of over 1,200%. Now, most retail traders treat support and resistance like a coloring book. They draw a dozen lines on a chart and hope the price bounces off one of them. That is not a business model, that's just a guessing game. Today, I'm going to show you how to map the market like an institution. We're going to strip away the retail noise and focus on where the big money is forced to commit capital. If you're struggling with scared money right now, it is likely because you're trading lines that the market doesn't actually respect. By the end of this breakdown, you have a clinical process for identifying the only levels that matter. This is the math that funds my brokerage account, funds my property, funds my family. Let's talk about why most supply and resistance content is a trap. Retail education teaches you to draw diagonal trend lines. The problem is that algorithms don't see diagonals. They see price and they see volume. When you trade diagonals like over here on the left side, you're trading a moving target. That creates scared money. You're never quite sure if the line is right or if you just drew it incorrectly. In the asymmetric edge system, we only care about horizontal gravity. Institutions have buy and sell orders parked at specific price points. These are not suggestions. They are mathematical commitments that they must do. Now we're going to map three specific types of gravity here. If a level does not fit into one of these three pillars, we just ignore it. Pillar 1 is the historical pivot. We look for price points that have caused a massive change in direction at least twice in the past 180 days. We're looking for institutional memory. If the big money has defended this level recently in the past couple months, they're likely to defend it again now. If you take a look at SPY, you can see this big red candle back here we had in October. You draw a support line at the bottom of that day's close. You can see we came back and retested it again in November, but institutions defended it back here because we bounced from there. As we retested again in November, the big institutions have an interest at this level to hold, so they step in and buy again. That's the difference between drawing horizontal lines and vertical lines. The second pillar is the volume magnet. This is where we look for high volume nodes. This is not an indicator, it's more of a footprint. It shows us exactly where the most shares changed hands. This is also the fair value where the market is comfortable. When price moves away from this node, it creates an asymmetric gap. That gap is where we find our daily setups. To find the volume magnets, take the volume profile, and we'll go back to this day again in October. Drop the volume profile there, it gives you this horizontal line. You see it's at 683.19. And if you don't want this mess of the volume, you just get rid of it, get your horizontal line, just find 683, as close as you can get to 683.19, and draw your line there. As you can see, that's been a big support and resistance level. The market's just chopping around there. It's a great level to have in mind. The third pillar is the Wick-to-Body consensus. Retail traders draw lines at the very top of the wick. This is a mistake. Institutions trade in zones, not lines. We draw our gravity zones with the candle body. The wicks are just price rejections. This creates a no man's land where we wait for a clinical confirmation before entering. And again, if we go back to this big candle in October, take our horizontal line, instead of drawing it on the wick up here, we draw it on the body. You can see it was resistance. It was resistance. We broke through. It became support. Right here, it got retested again in December. Why did it hold? Well, if you didn't have this level marked off, you would just think it was a random level. But we had this level marked off because it was important. It was the body of a control bar. Institutions have interest for these levels to hold. So when the price tests it, they step in to buy to make sure their levels hold. Now let's break down the deep physics of this a little bit more. Most retail traders think a support line is just a floor where buyers like the price. That is a dangerous oversimplification. In a professional business model, we recognize that support is actually a liquidity void being filled by institutional limit orders. When a major player, think a pension fund or a high frequency algorithm, needs to buy 500,000 shares of a certain stock, they can't simply hit the buy button. They would move the market against themselves by 5% and lose a lot of money. Instead, they park iceberg orders at specific levels. Let's take a look at Hood here, for example. You can see back last summer, we had a little gap in the chart here. It might not be that easy for you to see, but once you learn these things, they're pretty easy to find. So we had a gap in the chart. We draw a line where the gap opened that day and also the previous day where the gap began. These are huge levels to hold. Institutions will park massive orders down here. This creates a little buy box. And this box isn't just a line, it's an institutional commitment zone. When price enters down here in these areas, it hits a wall of passive buy orders. This is called an institutional fingerprint. We don't trade this simple little bounce. We trade the fact that big money is defending a position that they spent weeks, months, maybe even years building, such as this back here. As you can see, it came down and tested these levels yesterday and had a big bounce today. Looking for a nice continuation out of hood from these institutional levels. It just comes down to support and resistance lines once again, but you have to know where to draw them. You can't just throw your lines all over the chart. Now let's talk a little bit more about that volume profile. To remove scared money from your execution, you need a tool that doesn't lie. That tool is the volume profile. Come up here and drop it in. We're using that same gap up from last summer where we have our previous support and resistance lines. You can see right here that there's a high volume node. This represents the fair value consensus. This is where the most money has changed hands. And in our system, these are the strongest magnets of gravity. As you can see, this level was huge resistance for a while. We broke through, it became support. It came down and retested it. Now, just because it breaks through doesn't necessarily mean that the support line is broken. You need a candle close below it. And most of the time you need a retest and then a breakdown again for it to be failed. As you can see here, it just broke below this level and it ripped right back up and it closed above it. Therefore, the support line is still valid. But if you come look over here, you can see we broke under it. We closed right at it, kind of just followed around. Then we made a decisive move lower once it broke. But again, all this line is where the most volume is at. Conversely, if you look over here, you can see there's low volume. These gaps are what I call asymmetric gaps. Price typically moves through these areas with almost no resistance because there are no institutional orders parked there. When we identify a gravity pivot at the edge of an HVN, we are looking for a move through that gap. This is how we find trades with a 5-to-1 reward to risk ratio. Also, if you take a look, the price moved through these low volume areas, again, with almost no resistance, kind of just shot up. And you can see it shot up right to where the next high volume node was. If you don't have this kind of stuff on your chart, you won't know where the resistance is. You think it's just a random level and you think it just randomly rejected there. But no, we have our volume profiles. We have the correct support and resistance levels. And we have these levels marked off every day in the community. Let's come back to this level right here where we broke this support line that I talked about earlier. I want to go a little bit more in depth here. If you're in a drawdown, this might be the most important lesson you will hear today. Retail traders always typically get stopped out here. They draw a line, the price breaks it, they panic sell, and then the market rips without them. They're just stuck on the sidelines watching. In a clinical business, we call this a liquidity hunt. Institutions need to trigger retail stop losses to find enough shares to fill their large buy orders. They purposefully push price below obvious support to create a panic. That's exactly what they did here. They took the price right down below this big support level from the high volume node. They ripped it down, went down almost 3 points below it. All the stop losses got triggered, and institutions stepped in and just took all those shares from everyone. They ripped it from down here at 102, 103 area, all the way up to about 135, 140. You missed about 40 points because you got stopped out right here. If you don't know these things, you're going to lose a lot of money. Or maybe not lose a lot of money, but you're going to miss out on a lot of wins. Since the candle didn't close below this support line is still valid. The candle closed up here, so it reclaimed the support line, even though intraday it broke. We don't buy or sell these breaks. We buy the reclaims. When price fails into a gravity zone and then aggressively snaps back, such as right here, it confirms that the institutions have finished their hunting and are ready to move the tape. This is the difference between a 9,000% return and being a case study of failures. What we covered today was pretty simple, but a little bit more in-depth look at the physics of institutional gravity. However, understanding this theory is only 20% of the business. The remaining 80% is the daily execution. Every single morning before the opening bell even rings, we are active in the asymmetric edge community, mapping out all of our levels. We don't wait for the market to move and then try to react. We have our gravity zone set and we're ready to go while the retail crowd is still guessing. When you join this community, you aren't just getting a set of lines. You're getting a seat on a digital trading floor where we conduct live trading sessions and real-time Q&As. If you're still battling the scared money cycle, There's no better cure than watching a clinical process executed live in front of you every morning. My goal is to move you guys away from the screen as fast as possible. I'm building an extensive library of educational content that focuses on one thing, making your trading so mechanical that it becomes boring. That is how I hit over a 9,000% return on my brokerage account in just almost 2 years. We're building a legacy here. This isn't about signals. It is about a sophisticated education that turns a 5 figure account or a 6 figure account into a real business model. Whether we are discussing the math of recovery or the specific nuances of how to get a 3 figure, 4 figure, 5 figure day run rate, everything we do is anchored in the reality of the brokerage data you see on the screen. This is your final notice for the founding member phase. We're opening the next and last round of founding member invites in the next week or two. If you want to lock in your spot and secure the $49 per month rate forever, you need to get your name on the waitlist at asymmetricedge.org right now. You can find that in the description. Once all these spots are filled, doors are closed on the founding rate, and the price will move to the standard retail level as we scale the floor. Do not stay trapped in the drawdown. Do not let scared money liquidate your potential. Go to asymmetricedge.org, get on the list, and let's get to work. Remember, as always, stay disciplined. I'll see you on the floor.